If I were to try and drop trading into a neat little bucket to describe what it is or what you do as a trader, it would be to simply say that trading is a profession whereby you manage information, and you manage information in such a way as to enable you to make a decision at the end of that management process. The unfortunate thing is that at present, there is so much information. Traders are inundated with bits and pieces. But not only that, we're inundated with the ability to manipulate that data in any way, shape, or form. And this creates a problem. In the past, the only information you had was price, and whichever information you created manually. Back when I started trading, there were still people who bought what were known as chart books. These would be books which had charts of the major commodities printed in them that were a month to 3 months out of date. And that would be the basis for reference for many of the decisions. They would use that data as a backdrop to backfill their own charts and then bring them up to date by hand. You can see that this is an extraordinarily laborious process and in many ways inefficient, but it did reduce the amount of inputs you had to deal with. And what in part has prompted this was, I came across this chart the other day, and this looks at the S&P intra-year declines versus calendar year returns. And it's an attempt to look at where you are versus where you might be at the end of the year. And the first question I ask whenever I see something like this is a very, very simple question. Does it add anything at all to the trading process? Sure, we can look at it, or we can make a judgment and say, well, at present we're here, and the worst for this year has been this. And so you can see turnarounds in markets. But again, does that in any way, shape or form add anything other than being a clever piece of information? Because you certainly can't use that for trading. You might be able to use it to build a narrative to make yourself feel better, but in no way, shape or form can you generate a trading decision from that. It would be foolish and stupid to try and do so. So the question you have to ask is, well, what is the context within which this sits? And in part, what I'm going to do is look at the routine I go through every weekend to try and place the information I receive in context. And in that previous chart, we had this range of values for the S&P 500 and its drawdowns. But there's a much easier way of looking at the data. There is always an easier way to look at data. The problem is we think that the more complicated we make it, the more difficult we make it, the more intelligent we are, and therefore the harder it is for other people to understand, which in turn reinforces our perception of how clever we are. But does it actually make any money? And we can present that data in a much simpler format. This is the S&P 500, which also shows historical drawdowns. And you can see at present our drawdown sits at 23.64% on the S&P 500. So it's a reasonable drawdown. It's not insignificant by any stretch of the imagination. In part, it seems so bad because the absolute numbers we hear in terms of the falls seem so large. But that has to be put into the context of the growth the index has experienced. And so it is actually relative numbers that count more than absolute. But humans are very, very bad at differentiating between the two. We misunderstand when looking at risk the difference between absolute and relative risk because we're not natural statisticians. So to look at the context of this, we can There's a few simple conclusions you can draw from this, none of which really directly help your trading. You can generate the conclusion that indices always drift upwards. That's a function of the way indices are constructed and continually rebalanced. Indices have periods of drawdown, periods where markets slip, prices go down. That is part of the natural cycle. And one of the things that still intrigues me to this day is the amount of whinging you hear from traders when markets do actually go down. Again, the law of gravity has not been repealed. Gravity is undefeated in all things. So when a market goes up, it will naturally go down at some stage. That is just the way it is. But we can begin to flesh this out and see if it makes any sense at all in terms of the way we see the market and how we trade. Just looking at this is interesting from an historical context. But other than that, it doesn't add anything to what we're attempting to do. And at the end of the day, what we are attempting to do is get to a point whereby we can make a decision about an instrument that says we're either a buyer, a seller, or we're neutral. We have no opinion. We have insufficient information to make a decision about it, so we move on. And this is just simply looking at the longer-term context. This comes back to what I said before. The market at present is going down. That's a given. But for the previous 12, 13 years, it did nothing other than with the COVID blip of go up. And it showed quite a substantial gain. So there has to be an expectation that markets will, at some stage or other, fall backwards. And to be honest, traders present to me, in my observation, an interesting paradox. If you were to poll traders, particularly in the US, as to their political leanings, they would be right of centre. They're very much this somewhat childish, eat what you kill sort of mentality. Small government, small taxation, no assistance for anyone. What they fail to understand is their bull market was given to them by government assistance in terms of various reserves around the world generating a low interest rate environment and printing money. That's now changed. And they're whinging about it. So they're whinging about their welfare being cut off. This is a side point. But my advice to you is that if you're whinging about the fact that markets go down, and you don't know what to do when they go down, perhaps find something else to do for a profession because you're not really cut out for this. So, little rant aside, even if we look at the blip from COVID, we can see a substantial gain. And COVID was a reasonable blip, but it's a blip that only lasted a month. And then the market resumed its upward progress. So, whilst they're interesting, and they tell me a little bit of a story, we come back to another question. And trading is a function of asking yourself questions. And the question is, does it fit your strategy? And this is where I want to talk about routine and what my routine is. Each week I take a step back and I look at where a given market I trade is. Now, I trade the S&P 500 using daily charts. And I see some interesting things when I look at this. I see a market generates lower highs, small recovery, then a breakdown again. But the thing that interests me is the chart at the bottom, which is volume. And on average, the volume on down days is higher than the volume on up days. So the market has a lean on. The market has pressure on it where sellers enter the market at any given opportunity. And that's an important thing for me to know because this gives me an idea of what the overall trend is. And one of the prime rules of being successful in trading is be cognizant of what the overall trend is. If you're not cognizant of what the overall trend is, then you're going to be in trouble. You're constantly going to be fighting against the trend. And traders do this on a fairly regular basis. It seems to be a pattern that if the market presents to them that it is going down, they want to go along. Whether this is a function of ignorance or self-sabotage or a combination of the two, I don't know. But for me, if this was presented to me and I did not know what it was, I would either looking to be someone who stood aside, or I would be a seller of this market. Why would I be a seller of this market? Well, because it's drifting down and the volume on down days is higher than the volume on up days. It's as simple as that. And you'll notice I've taken this chart from TradingView. You'll notice a lot of the charts I generate are not in any way, shape or form proprietary. I simply use free services to quickly give me an indication of what is going on. The point being that there is no need for immense complexity in your analysis. You can generate first-order decisions very, very quickly from things that are free. If we look at our market, this is the S&P 200, and this is a weekly chart. Slightly different pattern to the S&P 500 in the US. You can see that we've got this broad congestion in our market with this last weekly candle being very, very strong. That is deceptive because it will not factor in the Friday close in the US. So we're playing catch up. But this still to me says that if I were an equities trader, there's not a lot here for me to get excited about. There is our resistance at around the 7,000 mark. We do have this artificial floor, but other than that, this market just churns. There is nothing exciting about it. There is nothing to get wrapped up in. And my next step, because I also trade this daily, is to wind this down. And you can see our support resistance. And again, it's nothing to get excited about. Again, if anything, looking at this, given the lean in the US, I would be biased towards the short side for our market because there's not a lot going on. But you'll notice that these are quite simple forms of analysis. It's simply bringing up a chart, looking at it, getting a sense of what the overall trend is, and then moving on from there, which brings me to this, what I consider probably the most important part of my routine. Make your life easier, not harder. Traders want to make their life much, much harder than it should be. You can achieve a great deal more by doing less. Trading is not a profession that pays you by either the number of hours you put in, the number of neurons you apply to something, or the amount of time you spend spinning your wheels, searching social media, going through forums, generating bogus charts, getting in Excel, mucking around with data. You're not paid on any of those at all. You're paid on your decisions, and you can make your decisions really quite simply by using simple methodologies and a very, very simple routine. For example, on a weekend, to get a broad overview, this sort of largely replicates to a degree the basis for commodities I trade on a daily basis. But because you are trading something on a daily basis, you have a tendency to become myopic. You often miss things that are going on. You're looking so hard you don't see them. So it is often best to step back and to look at a longer term time frame. And this is the 1 week relative performance of generalized basket of commodities. This chart comes from FinViz. It is completely free. And the moment you open this, you see something interesting. And that is the big four for the week were heating oil, crude, West Texas, gasoline, and Brent crude. That's telling me a story. Every time you look at a raw chart like this, which is unencumbered, uncluttered, unmodified, it tells you a story. And the story it is telling me is that the energy complex is doing something interesting that I might, as someone who looks at these things every day, might have actually missed the implication of that, because you can see things without actually taking in what is occurring. It's then a simple matter for me to open this chart that is offered by Finvius that looks at these instruments on a daily basis and just plots them. Now, a little bit of a trick here, and this catches people all the time. People think that West Texas and Brent are two different things. They are, sort of, but not from the perspective of correlation within your portfolio. If you have both of these instruments in your portfolio, you have one instrument in there. There's something wrong with your risk balancing. You need to drop one. And you'll notice that the ethanol chart looks very dodgy. So that can go as well. And so I look at this and I see a reflection of the chart from before. I see that crude in both forms is very strong, as is heating oil. And so that's telling me an important story. That if I have missed this, I need to go back and work out why I've missed it and to work out what's happening. But this is a first order decision-making pass. It's a broad brush. It says, take a deeper look at what is happening. So then it's a matter of looking at Brent crude in more detail for the way I see the world and for whether it is worth putting money on. And you can see that Brent, as per these charts, is making a series of higher highs. So my system did actually fire earlier in the week and has given a go signal on Brent. But this only comes into play further down the track when I've done some very, very simple global analysis and looking at what's actually happening in the world as a whole, not staring at one thing endlessly and trying to think of what might be happening. This requires a degree of dispassion and a degree of stepping back before you make a decision. And I will repeat this exercise for currencies. This is a tablet of currencies I follow just to get a sense of the strength in the US dollar, which has been very prevalent at present. And you can see that the strongest here has been the US dollar versus the yen. But what it also confirms in me is the continued collapse of the euro versus the US dollar. So I have two environments where I would be primed and looking for either being long or adding two longs. And again, this comes from Koifin. Koifin is free. You simply have to sign up. And all these bits and pieces are available to you. So the point I'm trying to convey is that simplicity and routine win. And they always win because it is that consistency. Traders believe, or many, let me rephrase that, many traders believe erroneously that trading is simply a series of making home runs, one after another after another. No, it's not. It's turning up, you pay your money, you take your chances, you rinse, repeat. Occasionally you'll get malleted by the market, but over time, if you survive long enough, your system will pick up things like these movements in their early infancy, and you'll be able to take advantage of them. And these sorts of moves are account-changing moves. They're the sort that make a tremendous difference to an account over the long term. Many people put up these charts that look at compounding, and they say, well, look at the difference between compounding at 20% and 22%. And granted, the difference over time, a very long time, is quite dramatic. That's how compounding works. But trading works on a form of punctuated equilibrium. So it, to a degree, uses the features of compounding, but it does so in an episodic manner where it jumps. Your account should have jumps in it. If your account is meandering on a regular basis, then I think there's something wrong with it. You're not picking up the big winners, or the big winners are being cancelled out by big losers. What should happen is your account should meander upwards very slowly for certain points, and then accelerate and explode, then slow down, and then repeat the process. If it just drifts, there's something wrong and you need to look at it. And the final point, and this is a general point that I live by in all my trading, irrespective of the instrument, irrespective of the time frame, and that is to find the predominant trend. If price is going up, you can only ever go long. If price is going down, you can only ever go short. To do anything else is suicidal. But what that requires you to do is to work out what the background trend is. Now, working out the background trend does not mean you look at a 1 hour chart and go, well, the 1 hour chart is going up. I trade daily, therefore I'll go long. It's quite the reverse. It is looking at the weekly chart and then moving down to the daily and making your decision there. This notion of defining the predominant trend requires you to do something that traders are very, very poor at. It requires you to be patient and to step back. But more importantly, and this is the final point I'll make, it requires you to remove yourself from the decision-making process and simply trust the data, so that when you see something like this, you can accept what the system is saying to you, you can take the trade, put it in place, let it sit, leave it be, and move on.